CPI report came out last week. It was hotter than expected, and it basically guaranteed that the Fed at its next meeting, which is this week, will raise by at least 75 basis points to the 3 to 3.25 level. The stock market reacted very negatively to this and sold off sharply. And when we take a look at the situation, the biggest concern with the CPI was that the core increased at a 0.6% rate month over month, which doesn't sound like a lot, but annualized that is a 7.2% increase on the core rate annualized. The year-over-year numbers have come down the past couple months, and we are now looking at a year-over-year, which is 8.3% over the overall CPI. That's down from 9.1%, but the core is giving people concern. When you take a look at what's been taking place, we've had a very high inflation rate here the past year and a half. We have gotten some relief on the gasoline prices, and that's one of the reasons that we've backed off from the highs on inflation, and we basically had a flat month over month total CPI. But when you X out the gasoline, the core CPI, which is X gas and food, did have a pretty significant increase. Energy prices go into most products and take a little while to work through the system, but they are clearly working through the system right now, and that inflation is seeming to be stickier than people had hoped. The rate increase is clearly something that the market is focused on. As long as rates stay below the inflation rate, we're really not tightening the system that significantly. We basically have been in a position over the past 14 years of incredibly accommodative monetary policy with quantitative easing 2, quantitative easing infinity, quantitative easing during the COVID crisis, and the Fed's balance sheet has expanded from $800 billion to $8.9 trillion, back in April. It actually got to $8.965 trillion, $35 billion short of going to $9 trillion mark. So these numbers are pretty incredible that the Fed's balance sheet has expanded at such a fast pace and basically flooded the system with liquidity, driven down interest rates and until recently, and basically caused asset prices for almost everything to go up, real estate, stocks, cryptocurrencies, as the Fed was expanding its balance sheet. Now that we're in reverse and the Fed is promising us quantitative tightening, we should see some of these bubble aspects to continue to come out of the system. The Fed has been very slow to implement their quantitative tightening as they had promised. So we were promised that they would get going in June, July, and August at a $47.5 billion shrinking clip of the balance sheet, and that has not materialized. And then we were promised that in September they would accelerate to a $95 billion shrinkage of their balance sheet per month starting September. September number on a first couple of weeks is extremely disappointing when you take a look at their goals. As opposed to a $95 billion rate of decrease, we've actually seen a $12 billion increase in the Federal Reserve's balance sheet during the month of September so far. We'll see if the Fed is actually blinking or there's just some technical issues that created that anomaly, and we'll see what happens in the second half of the month. But if the Fed is blinking, it does mean that we're getting closer to the end of this sell-off in stocks and sell-off in interest rates, sell-off in bonds, and it'll get a little closer to the time point when you can re-enter the stock market on a sustainable basis, not just trying to trade a bear market rally. However, the Fed has been talking about the need to bring down inflation. They've been trying to talk tough. My guess is that the first couple weeks of September were just a technical anomaly, and that we will see an acceleration of the Fed balance sheet tightening here in September and through October. At some point, I do expect the Fed to blink. I think that is at least a couple months out. I'd be surprised if they blink already, given the rhetoric coming out of the Fed. But we're going to monitor the balance sheet situation extremely carefully. To keep in mind the explosion of the Fed's balance sheet over the past 14 years from $800 billion to $8.9 trillion, almost $9 trillion, occurred, at a very aggressive pace, and basically caused the stock market to get extremely strong. We think that the element that has been the driver here is we had these huge deficits, both during the financial crisis and also during COVID. The deficit is coming down somewhat. We had a $2.7 trillion deficit for 2021. That was a lot of COVID stimulus, COVID expenditures, lower growth and lower tax receipts. And then this year, it looks like we're going to come in close to a $1 trillion deficit for the federal government. These numbers are still extremely high and unprecedented, but they are moving in the right direction. The problem here is, as long as the federal government is creating these deficits, that means they need to issue more treasury bonds. And the biggest buyer of treasury bonds, the Fed, has said they're going to actually stop buying and actually reduce their buys and reduce their balance sheet. Another player that's been a big participant is China, and they've actually started shrinking their treasury holdings, so they're no longer going to be buyers. And so what probably happens, at least in my opinion, is that the bond prices, as they come to market, will need to go down, making interest rates higher to actually attract other buyers besides the Fed, which was manipulating the market, and China. There's clearly some other big global players. Japan's still a big holder of treasuries. But those items, when you look at what historically has been the case for the 10 and 30-year treasury, they have historically approximated nominal GDP. Nominal GDP is inflation plus real GDP. So let's give it a 2% GDP growth rate, a 3% inflation, which is much lower than where we are right now, and that gets you to a 5%, 10 and 30-year treasury rate. That is up substantially still from where we are today. Although we have had big increases in interest rates, on a year-to-date basis, that would indicate that if we go to market-based pricing, if the Fed's not going to manipulate rates down by buying all these treasuries and mortgages, that we still have some room to go up on interest rates. If interest rates go up, that's clearly a negative for stocks, especially high PE growth stocks, as they have to compete for treasuries, which are a risk-free rate as far as default, and that makes it a very difficult environment for stocks. So that said, I'm remaining cautious with my own portfolio. I have a considerable amount of cash and neutral type positions toward the market. I am looking for an opportunity to get more aggressive and put some of that cash to work, but I do think it is still too early. I'm monitoring the Fed's balance sheet very closely and will adjust as the balance sheet information becomes more available. If quantitative tightening continues as planned, I think staying with large cash positions, limited stock exposure, limited bond exposure is still warranted. Once that stops, once the Fed blinks, I do think you're going to want to reverse and get some of that money to work in both stocks and bonds. This is what I'm doing for my own portfolio. I hope you find this information helpful. Please take a look at our website, buildingbenjamins.com, where you can see a full disclaimer. You can also take a look at signing up for our email so you get this information on a more timely basis than you do if you just wait for it to come out on social media. This is Ben Halliburton, and I hope you have a great day. Thank you.